Welcome back, everyone, to Real Estate 360 Live. I'm your host, Ryan Sloper, joined by my guest, Cammarosano, the General Manager of HomeGain. Reminder, the show is designed to build the Washington, D.C. Metro's housing and credit markets one house at a time. If you ever have any questions, concerns, or real estate needs, the best number to reach out to us is 877-245-2030. That's 877-245-2030. That's for any questions you guys may have, whether you're trying to obtain a loan modification and are unsure if you're heading in the right direction, or just getting frustrated and want to know what your options are. I'm glad to help you out with that. If you're just looking to buy or sell real estate and have general questions about the process or where you should start, that's what we're here for. It's 877-245-2030. So I want to, before we jump into this week's questions from listeners, I wanted to go over, I thought it was interesting, Louis, that every year, basically the Fed does stress tests on banks to basically say, let them know what the capital levels they need to keep on their balance sheets in case, basically Armageddon happens. This year, it looks like they're saying that under the severely adverse scenario, that banks will need to test their balance sheets and capital levels for the capacity to withstand the following items: a decline of 5% in real GDP by the end of 2013, a corresponding jump in unemployment to nearly 12%, a 50% drop in stock prices, and a 20% fall in home prices over 2 years. Now, of course, that's not them forecasting or anything like that. That's just saying that if everything were to go very bad, that would happen. The Fed was very careful to note that none of these things that they put out are actually their expectations, and they actually feel that these are much dire scenarios. But I actually don't think that it's too far-fetched to think that we can't go that route.
No.
And I mean, and
it could be worse than that.
Exactly. And the fact that they brought it up, and that these are, the severely adverse scenarios, is acknowledging the fact that they are paying attention to what's going on, and they think that it's potentially going to get there. So, I mean, I think that this stress test and what they came up with is actually very, very telling to me. They went on to say that their baseline scenario was that the U.S. is going to grow at an average of 2.75% through the end of 2015, at which point unemployment is down to 6.75%. That's not going to happen. I mean, they've already said that they planned on keeping interest rates low for an extended period of time, well, probably into 2015. So the economy is going to remain stagnant. I mean, it's not going to really do anything because of the debt that this country has and the inability of Congress or anybody else to actually step up to the plate and do something about it.
Especially if you raise taxes on anybody.
Yeah, raising taxes, and we have the fiscal cliff that we're headed towards. None of this stuff is good for the overall economy. It's just not. So, I mean, I do want to, note that, this little tidbit from the Fed could prove to be very telling a year from now, and it could be sooner. We just don't know. We're just going to see how things play out.
Well, Brian, what happens if, as you know will happen, they will avoid the fiscal cliff, they'll keep all the spending, maybe they won't raise taxes on anybody, or maybe they'll just raise taxes on the so-called wealthy.
Right.
That's going to actually cause people to rejoice and for the stock market to go up.
Yeah, it's crazy. I mean, that's just because it's like the stock market, Wall Street at this point. They're just following everything that the Fed.
Going.
Exactly. I mean, because everybody knows that this is not something that's headed in the right direction. The average person is not investing in the stock market. I mean, this is hedge funds and financial institutions that have their money in there, and it kind of stinks because
person doesn't have any money to invest at all.
Right, and for the people that do kind of start to buy into this stock market, and they put their money in there, and then all of a sudden they lose it all. So, to me, it's all around just terrible. I think that, people always ask me, well, you're always saying that, this inflation, everything could kick in and everything could get terrible. Where do you think could be, how soon can that happen? And I mean, I have no way of knowing that because the amount of manipulation that goes on in our markets right now, this could take years. It could. I really don't know, and that's why I said the only thing I can worry about is today and what can you do today to protect yourself. And obviously, taking out a mortgage and locking yourself into the low fixed rates would be a smart way to go about doing that. That's at least going to keep one of your most your major expenses fixed for an extended period of time. But I can't really tell you, whether I think that's going to happen in the next 6 months. I mean, I think this is probably going to go on for another 3 or 4 or 5 years. I think that's just probably the likely scenario. And that leads me to one of the listeners' questions. Well, where do you think interest rates are going to go in the near term and in the long term? And obviously, I would say just follow the Fed. The Fed basically has given all indication that they plan on keeping interest rates, or they're going to try to keep interest rates low, because the way they do that is they keep buying mortgage-backed securities, in the billions, and so it's keeping interest rates.
And they set the interbank rate too.
Exactly, and they set the interbank rate. And so if you follow kind of what they're doing and what they're saying, it's basically saying that interest rates will stay low for an extended period of time, maybe for the next year or two. But remember that their whole plan could become derailed if people actually get smart and realize that, hey, what they're doing is not good, and everybody else starts to dump their money out of these type of securities. So, in which case the Fed would turn around and buy even more of it.
That's true.
You know what I mean?
I thought that would have happened in the 2008 crisis, but they rushed to the safety of the problem. They bought more U.S. Treasuries.
Right. So, I mean, I guess at this point, I guess, I can say that you're somewhat protected by the Fed, guys. So, if they're going to do this, then you can take advantage of, if you can take advantage of the fixed rate interest rates, then you should do so. And if you want to buy more property because you qualify, do that. Because, I don't think anybody's complaining buying investment properties in the 4% range.
Well, unfortunately, the best thing that can happen to a mortgage holder is that the Fed finally outdoes itself and the whole thing collapses, and you still owe money, but the paper that you pay it back in is useless and worthless, and you can easily pay it back.
Yeah. Yeah, I mean, it's, there are numerous, investors out there that I know of just in the D.C. market that are trying to buy up everything they can possibly get their hands on. And I think it's pretty telling. I had pulled up a little graph. They were showing the inventories, and I believe this was from the KCM blog, which had just showed where the inventories across the country are. And in the D.C. metro market, our inventory from last year over year is down 23.3%. Out there in San Francisco, it was showing down 42.2%. Does that sound pretty consistent out there, Lewis? A decline in inventory from last year?
I guess either there's some demand, and then people take their homes off the market if they're underwater.
Yeah, or many people they put their house on the market and then find out that they can't get what they want to get for it, so they have to take it off and inevitably live there. And so they did an average across the United States, and it shows an inventory decline of 19.4%.
The area that I'm most interested in are where there's declines is where there's really liquid markets like Arizona, Florida, places that were really hard hit that had serious declines in prices, not ones that have high prices already.
Yeah, it was showing, Las Vegas, it was showing a decline of 35.4%.
That's telling.
Phoenix, Arizona, 38.4%.
They bulldozed a lot of those new homes, too.
Yeah. Yeah, and I mean, in a lot of those homes, like out there in the Nevada, Arizona area where, you could pick up homes at like less than $100,000. I mean, that would start to clear through a lot of inventory. I mean, that, investors could buy 3 or 4 or 5 of those each. So, in those areas, I think that's probably why we have seen a substantial decline in inventory. And,
as long as there's an economy within, 20, 30 miles of those homes, that's a good price.
Right. So so we have housing inventory that's going down. So it leads me to the next question from Brian that says, should I wait until the spring market to put my house on the market? Because I think that I might get more bang for my buck. Right now in the DC metro area, basically we have a housing shortage, okay? So I don't think by waiting till the spring that you're necessarily going to, increase the amount of profit you're going to make, because I think that even now there are many buyers that are out there that want to take advantage of where home prices and interest rates are, and they're going to do so now. I don't really think that it's going to change much. Most of the time, obviously, we have it's a slower where prices would retract a little bit going into the winter months, but to be honest, Lewis, I think that this winter, especially in the D.C. metro area, is going to be an anomaly. There's a surplus of people that are out there looking to take advantage of these, and they don't care when they have to do it. Especially good homes. Good homes that don't need much work are flying off the market. And it doesn't matter, whether it's right around Thanksgiving, Christmas, New Year's. People are just looking to get in. And it's really stemming from the frustration of being left out on other properties where there's multiple contracts. So, I say that, if you're looking to do it, I would put it on the market actually now, because I really don't think that between now and the spring you're really going to change. I mean, and ultimately a lot of things could change. I mean, interest rates could go up between now and then. So if you just look at the information that's in front of you today, where interest rates are, the housing shortage that we have in inventory, I would say just put it on today, because I think you're going to maximize your dollar today. We don't know where interest rates are going to be in the spring. They could be slightly higher. So that would be,
Ryan, if the fiscal cliff does turn out to be they can't come up with a solution and these automatic cuts take place, that would hurt the housing market.
Yeah, absolutely.
If they pass something and it's not going to help the housing market. So your point is, if you can sell now, because you're not really going to do much better in the spring.
Exactly. We're coming up on the end of the show, Lewis. I want to thank you guys for coming on, and appreciate your insights. Guys, if you want to start your search, please check out HomeGain.com today. You can compare realtors anonymously. Lewis, I appreciate it as always, buddy.
Thanks, everyone. Thanks, Ryan.
Guys, thank you, and we'll be back again next Monday from 9 to 10 a.m. Have a great week, and have a great Thanksgiving.